Good afternoon, everyone. Thank you so much for joining us. We are here at the ISAC offices. We have Jan Hawkins, the Senior Retirement Benefits Officer from IPERS, and Matt Ring, a retirement specialist from Nationwide Retirement Services. Just a couple housekeeping things to get us started out before we start this great presentation. Everyone is currently muted, so we cannot hear you if you're talking into your microphone or speakers. If you need to contact us to ask questions, if you can't hear, if something's going on, you can use the questions box. There's a little red arrow. If you click that out, you'll see a questions box appear. It says enter a question for staff. You can just send that and we'll get it. There is a great number of people on this webinar, so we won't be able to get to everybody's questions. What we can do is we will print off a full list of the questions, which include your contact information for our presenters, and we'll send them to them, and they will get back to you sometime in the relative near future. Again, we will have a lot of questions, I'm sure, so please be patient. Otherwise, you can send them to us as well via my email or Tammy's email, and we'll get them to them as well. There is a handout of this presentation on the ISAC website at www.iowacounties.org under the Meeting and Events tab. Scroll down to Webinar, and you'll find that there. At that same place, we will have a recording of this webinar as well. So you're welcome to share that with any of your staff to watch it again. If you have to miss some of it, it will be on there for your viewing pleasure in the near future. Again, if you have any questions, please feel free to use that tab. And otherwise, I will hand it over to Jan.
Good afternoon. I'm Jan Hawkins, one of your retirement counselors at the IPERS office. And today, we want to give you a general overview of IPERS and your benefit options. So what is IPERS? We're the largest public retirement system in the state of Iowa, and our members include, of course, employees of counties, state government, cities, public schools, state universities, our community colleges, our state board of regents. And to date, we have approximately 340,000 members, over 2,000 employers, over 108,000 retirees. In this past fiscal year, we paid out over $1.8 billion in benefits. What type of plan are we? We are defined as a 401A under IRS code, and for you that means that your lifetime benefits are based on a formula, not on the amount of the contributions that you pay in. And those factors that we use in calculating your payments are 1, your age, 2, your years of service, and 3, your highest average salary. You may recall prior to the law change, July 1, 2012, that we based your calculations on your highest 3 calendar years of wages. For our regular class members, effective July 1, 2012, that did change to the high 5 calendar years of service. So when you do retire, we will look at your high 3 average as of June 30th, 2012. Compare that to your current high 5 average, and we will use the better of the 2 in calculating your payments. So what's your part as far as contributions? For our regular class members, you currently pay in 5.95% of your gross wages. Your employer's 8.93%. And following an actuarial valuation from year to year, we now as IPERS can adjust that contribution rate by no more than 1% up or down. If we do have any protection class members listening in, for you, your current contribution rate is 6.76%, and your employer's 10.14%. Protection class would be those fields such as our police officers, correctional officers, etc. And for our sheriffs, you currently pay in 9.88%, and your employer's the same, 9.88%. What is vesting? For you currently, our vesting status is currently 28 quarters, or 7 years of reported wages, or someone age 65 contributing to IPERS. You may remember prior to the law change July 1, 2012, that used to be 4 years of someone age 55, so that has now. And that's going to entitle you to, 1, it entitles you to a lifetime monthly retirement benefit with IPERS or a disability benefit. or if a member would terminate their IPERS employment and choose to take a lump sum refund payment, if not vested, you would receive only your contributions plus interest. But if you are vested, you will also receive a portion of what that employer has paid in for you also. And vesting is also a qualification in the event you would like to purchase additional years of service with us. So let's take a look at your benefit formula when we calculate your payments. For our regular class members, if you're looking at the chart, at 30 years of service, which is bolded in black at the bottom, when we calculate your payments, you will get 60% of the average of your highest salary. For years under 30, you will see that that's decreased by 2%. So if you look at the chart at 20 years, you would receive 40% versus at 30 years receiving the full 60%. Then just to reward our members, once you reach 30 years of service, we will add a 1% to that up to 35 years. So after 35 years of service, you'll receive no more than 65% of the average of your highest salary. For our special service members, which again are those members in an occupation that would carry a gun, or our sheriffs or protection class or firefighters, at 30 years of service, you would receive 72% of the average of your high 3 calendar years of wages. Normal retirement age. We currently have 3 definitions of a normal retirement age. Number 1, age 65, regardless of your years of service, or the rule 62-20, someone age 62 with at least 20 years of service, or the most common one, rule of 88, when your age plus years total 88 or more. You would just have to meet one of these definitions to meet a normal retirement age, and by meeting one of these definitions, that wipes out what we refer to as early retirement reduction. If you have not met one of these 3 definitions at that point of retirement, you do receive that reduction in your monthly payment. And how that reduction is figured, we reduce 3% a year for a portion of service through June 30th, 2012 from your nearest normal retirement eligibility date. And what that means, for instance, if we have a person that, say, age 60 with 27 years of service, that person is 1 year away from meeting the rule of 88. Prior to the law change, July 1, 2012, that person would have received just a 1 year reduction at 3% a year. Now effective with the law change July 1, 2012, with that same scenario, someone 60 with 20 years of service, if that person at June 30th, 2012, for those years prior to that law change, only had 26 years, then after the law change had 1 more year service, for the years of service prior to the law change, they would receive 3% reduction. But for that 1 year service after the law change, because that person is only age 60, we would figure that reduction strictly from age 65. So if that individual did not continue to work 1 more year to meet the rule of 88, they would receive a 5-year reduction at 6% a year. So we would encourage you to call our IPERS office to get your own personalized estimate. What if you have not met a normal retirement date? Some of you may be entitled to free credit. If you've ever been on a leave of absence prior to July 1998, you are entitled to free credit, and that would just require verification from your employer. Or if you were ever working with an IPERS employer, were called to active duty, returned back to work within 12 months of being discharged, you would also receive free credit for that time that you were in active duty. We just will require a copy of your DD-214. Now, if you have not and are not eligible for free credit, you are entitled to purchase additional years of service. We do currently have a new law change beginning in January 1, 2016. Currently purchase years of service while actively working at retirement and after retirement. In January of next year, purchasing will only take place during the retirement process, which means that you'll have a one-shot time to make that purchase, and that will be at the time that you actually retire. submit your retirement application, and at that time we will give you an official cost quote, which you will have a 6-month window still to make that purchase. So currently right now, through the remainder of this calendar year, you do still have your current service purchase options. If you've ever worked with IPERS in the past and took a refund of your IPERS, you can currently buy that time back. If you've worked with IPERS employment not previously covered, you can buy in that time. If you've ever worked in the public system in another state or another public entity, we would allow you to buy in some of that time. Ever been on active duty military or leave of absence that was not eligible for free credit deductions as a non-qualified service purchase, which simply states if you have at least 5 years with us and are vested, we give you up to 5 years you can purchase. And our last one is what we refer to as our IPERS by a credit conversion, which means if you've ever worked 1 quarter in a special service field, such as police officer, correctional officer, or a sheriff deputy, you can pay to convert all of your regular service to that special service time. To do either, you would just need to submit an application for service purchase. That application is available at our website, or you can certainly call our office to request that. We will then calculate that service purchase cost by submitting that currently to an actuary out of our office. It takes about 3 weeks to get that cost back, and we'll send that information to you in the mail, and your cost quotes are valid for a 6-month window. Now, in reference to the new law change, just keep in mind now that effective next year, you will only be able to purchase at the time of retirement. This gives you other options to save up for a purchase, such as saving money in a separate retirement account that can eventually be rolled over to our IPERS office to purchase your service. So let's quickly just go through your 6 monthly options at the time of retirement. Just a couple of things to remember: our options and our pay-to-you lifetime as a member. The only difference in all 6 options choice is what you choose to leave payable at death to your beneficiary. But once we pay you your first monthly payment, that option choice can't ever be changed. So just to give you a quick summary of your option choices, Option 1 looks at the amount that you have contributed to IPERS and states that we will pay you a lifetime monthly payment, and at death pay a one-time lump sum payment to your beneficiary, then close the account. So in the event you're a member that has currently invested $100,000 in IPERS, you can choose to designate anywhere from $1,000 up to $100,000 to be paid at your death and a guaranteed one-time lump sum payment. Option 2, death benefit only if the balance of your investment remains. So at the time of your death, we would look to ensure that we've paid out all of your investment, and if we've paid you that and more, there's nothing left for the beneficiary. But in the event you've died early and we have not paid out all of your monies, your beneficiary will receive the balance of your investment. Option 3 pays you the most money, but with no death benefit at all. Options 4 and 6 are what we refer to as our dual life annuity. This option allows you to draw a monthly payment, and in the event of your death, we would continue to pay one person and one person only a lifetime monthly benefit for the remainder of their life. The only difference between option 4 and option 6, with option 4, in the event that that one person would pass away before you, you would stay at that reduced amount under option 4. Whereas under option 6, in the event that one beneficiary would pass away before you would, we would then pop your monthly payment back up to your full benefit amount under option 2. And your last choice is option 5. We refer to that as our 10-year monthly guarantee payment, which simply states that something's only paid to your beneficiary in the event you've died prior to 10 years. So with this option, at the point that you live 10 years or more, there's nothing left to the beneficiary, but we would continue to pay you a monthly payment for the remainder of your life. So what happens in the event that you've died prior to retirement? We will take a look at your pre-retirement lump sum death benefit to date, And if you've named a sole beneficiary and you're currently vested, that one beneficiary would be eligible for a lump sum benefit. Or we would also calculate a monthly annuity at that point and give them the option of drawing that monthly annuity or that one-time lump sum payment. But if your designated beneficiary is more than one individual or an entity, we would only be able to pay a one-time lump sum payment to those beneficiaries. So just a couple of things just to remember. Working any time in a month makes you ineligible for IPERS benefit that month, but you can get a check in the same month that you start your IPERS payment. So if you work one day into the month of June, you're not eligible to start IPERS till the following month, the last business day of the month. To get your monthly payment started, you must contact IPERS to request your completed application. However, if you're age 70 and still working, just remember that you can start your IPERS payments and continue to work. Otherwise, everyone else under age 70, you initially have to be age 55 or older, unless vested and eligible for an IPERS disability benefit. And remember, we start benefits a month following the month you do stop working. And we pay our benefits the last business day of the month for the month. Now, your benefits are subject to federal and state income tax, so at the time of retirement, you will have the option to have federal and state taxes withheld from your pension every month, and we ask that you do contact your own tax advisor regarding your tax information. Reemployment, which is a big question for our members. It's your responsibility, though, to contact IPERS if you're planning on returning to any IPERS-covered position. You must have a bona fide retirement period with us. And just keep in mind, if you are also drawing Social Security, they do have their own limits. So what is a bona fide retirement for our IPERS members? This means that you first must terminate your IPERS employment, file an IPERS benefit application, then stay out of all employment with a covered employer for 1 month, and stay out of employment in an IPERS covered position for an additional 3 months. What is your reemployment guideline? There is a limit to our members under age 65. If you do go back to IPERS covered employment, that limit currently is $30,000 that you can earn in a calendar year. Once you reach age 65, there is no limit. And at the time you would re-retire again, we will then at that point recompute your benefits upon termination. So we just ask that you do contact IPERS about 3 to 5 years, possibly from your retirement estimates, and then again about 6 months prior to retirement to request your application packet. Hope this gives you a good overview of your IPERS plan. Feel free to contact us directly. Our office hours are Monday through Friday. Phone lines are open 7:30 a.m. to 5 p.m. And also visit our website. We do have new retirement calculators, our handbook, and newsletters online. Thank you.
We'll let our presenters switch right now. Matt will be coming up soon. And just a little reminder that we'll be doing the question and answer period at the end. So make sure to just keep bringing your questions in, and we'll get them covered at that time. Thanks, Matt.
Good afternoon, everybody. This is Matt Ring with Nationwide Retirements. I am the State of Iowa representative with Nationwide, servicing our county plans for the 457B Deferred Compensation Plan. Pretty certain just about every county here in the state has a deferred comp, and most of you have Nationwide as your provider. We are the endorsed provider of the National Association of Counties, as well as the Iowa State Association of Counties. I'm going to talk here just very briefly, more of a broad overview in terms of how to build your retirement income, incorporating a lot of what you just learned from your IPERS representative, but also about other sources of funds that you'll either have or need to consider before making that ultimate decision to retire. So really just kind of a question for thought here is, how do you plan for and build your retirement income sources now so that you'll have enough money to retire whenever you're ready to do that? And what are the sources of retirement income anyway? What you're seeing on your screen is what is typically referred to as the three-legged stool of retirement: Social Security, pension, and personal savings. We actually surveyed recent and current retirees, and what we found is that workers are likely to anticipate piecing together their retirement income from several different sources. And when we asked them what they plan to retire on, over 70% said Social Security, employment, and 457B, 401K, 403B, or other similar retirement plans. Over 50% of respondents also mentioned that they plan on using IRAs, other personal savings, and traditional pension plans, again, such as your IPERS program that you have here in the state. And let me point out that the survey from the Employee Benefit Research Institute included respondents from private as well as nonprofit sectors where traditional pension plans aren't as prevalent. That said, it suggests that workers need to consider income resources beyond just their pension plans and Social Security. So let's go ahead and take a closer look here at the three primary sources of retirement income, starting with Social Security. The foundation of many workers' retirement income is Social Security. Most workers who have paid FICA taxes for at least 40 quarters or at least 10 years qualify for some benefit. Your Social Security benefit is determined by your earnings averaged over most of your career, 30 years, your age when you start collecting benefits. You can apply to collect Social Security benefits as early as age 62, but the monthly payment will be reduced by about 20%. Full benefits become available when you obtain quote-unquote full retirement age. Generally speaking, depending on your date of birth, it's going to be between age 65 and 67. Your benefit could also be increased for each month that you delay receiving benefits between full retirement age and up to age 70. Some public and educational employees are exempt from FICA taxes and may not qualify for any benefit. If you do qualify, your benefit may be reduced by federal laws covering the relationship between public pensions and Social Security. For an explanation of your eligibility or benefits, go to the web address on the screen, socialsecurity.gov, or consult your legal or tax advisor before making any decisions about your retirement. And one thing to note, on the Social Security website, there is a calculator where you can estimate your projected Social Security benefits, typically by entering in some of your personal information, date of birth, Social Security number, etc. Now let's talk about the second building block, a traditional pension. And as Jan just gave a presentation on, your IPERS program is considered a defined benefit plan because the benefit amount is defined by a formula that usually takes into consideration the number of years you worked, your age, your salary, etc. In most cases, the payment you receive will continue for the rest of your life. And again, I realize this is redundant because she covered all those options. While Nationwide can help understand how the building blocks of income fit together, you really should be talking to the IPERS program or your benefits manager regarding the specifics of that pension program. Also, you might be wondering how much retirement income is enough. Generally, accepted rule of thumb is that you should have a minimum of 80% of your yearly earnings while working. So in other words, if you made $50,000 a year while you were employed, you should have at least $40,000 a year to cover your retirement. What we just learned from our presentation a few moments ago is a 30-year IPERS payment will net you around 60% of your average salary, or potentially a little bit more if you work longer. So that means you'll need to find at least 20 to 30% more to cover and to make sure that you have enough funds to sustain your lifestyle during retirement. If that seems like a lot to plan for, let's talk about personal savings. Often the biggest block of all, and also the one that you'll have the most control over. An employer-provided retirement program, such as the 457 Deferred Compensation Plan, can help workers bridge the gap between just getting by and living comfortably in retirement. Your contributions are tax-deferred. You pay ordinary income tax on them and any earnings as you make withdrawals. Also, a great benefit of your 457 plan is there are no penalties and no minimum age that you need, just as long as you're retired and or no longer working for the county that you're currently working for. If your plan offers a Roth 457 option, you may also be able to make after-tax contributions so that the contributions and any earnings grow and may be withdrawal tax-free. Traditional IRAs allow you to contribute after-tax dollars and take a tax deduction when you file your federal income tax return. You pay ordinary income taxes when and as you withdraw from your account. And Roth IRAs allow no tax deductions, but any earnings grow and may be withdrawn tax-free. IRAs also may be structured within an annuity or other savings product. Many people also add their long-term resources by investing in stocks, bonds, cash accounts, and mutual funds. Just remember that each of these plans and investment options are different, including fees, when you can access the funds. Assets may also be subject to surrender charges, other fees, and or 10% tax penalty if withdrawn before age 59 and a half. With certain exceptions, you invest your contributions through the plan. Investing involves market risk. You could lose what you contribute, and as you participate in the deferred compensation plan, we at Nationwide can help you understand the market and other risks that you face and strategies that can help you deal with all those potential risks. Finally, there is another retirement income option that many people consider, and that's either working full or part-time. In June 2012, just about 1 in every 6 U.S. residents collected Social Security benefits. Why is this important? Because people are living longer and need retirement income to support them for much longer than legislators who wrote the Social Security Act envisioned. Continuing to work beyond your normal retirement age may seem like a good option to consider, as it increases the amount of Social Security benefits you're eligible for, but consider this. In 2012, again, research revealed that while 70% of baby boomers expect to work in retirement, only 27% actually had done so. You should also consider that your ability to work beyond a certain age may be restricted by other factors such as health issues or an unfavorable job market. While it may be easy to see yourself working past retirement age, just that possibility, quite honestly, may not be entirely within your control. So again, the importance is to make sure that you're saving enough, not fully relying on just the IPERS and Social Security, and going beyond into that third leg of the stool and saving in your own personal way, be it your employer benefits in the 457 plan or your own external accounts, IRAs, savings accounts, brokerage funds, etc. Again, the good news is that you have options. Today we've only had time for a broad overview of some of these more common options, but if you have any additional questions at the end of the call today or even later on, I'd be happy to discuss your questions with you, either via face-to-face appointments or over the phone or through email. Thanks again.
Matt, since you're right here, I do have a couple questions that came in specifically for you.
Okay.
Can you have several 457 Roth IRAs?
Yes. So, and let me clear that up. This is one of the common misunderstandings. There's a difference between a Roth IRA and a Roth 457. So a Roth IRA, generally speaking, stands for an individual retirement account that you would go out on your own as an individual and open up with a local agent, a broker, whether it's the Nationwide, Edward Jones, Farm Bureau, or whomever. The Roth 457 is the benefit that you receive through your employer, the county. And yes, it is possible to have multiple. In the case of the 457 plan, if you work for multiple counties that offer those plans, you can have a Roth 457 within each of those. The Roth IRAs, you can have multiples. The difference being an IRA limits do not allow you to contribute more than the annual amount across multiple IRAs. So if you max out, say, this year's limit is $6,000, if you put $6,000 into one Roth IRA, you cannot open up a second Roth IRA and continue to contribute. I hope that answers the question.
Thanks. Continuing with 457, can you use money that's already in a tax-deferred account and change it to a 457 Roth IRA?
No. So right now, the only way to fund a Roth 457 plan is through payroll deduction with your county. Currently, the IRS does not allow you to convert a traditional or pre-tax 457 into a Roth, and currently you're not allowed to, based on the tax laws, roll over or transfer a Roth IRA into a Roth 457.
Great, thank you. Alrighty. Now, a few IPERS questions that have come through as well, and then we have a few Social Security specific questions also. On a basic level, they have asked, what is an annuity, and does IPERS offer this?
IPERS does not offer an annuity. We're just strictly a 401A pension plan. With a lot of the annuities, the majority of them are not lifetime monthly payments to you, and that amount may fluctuate from year to year depending on the stock market, whereas with our pension, it's not based on any of those factors, but simply a formula.
Thank you. Alrighty. Do you need to retire during a quarter or at the end of a quarter to meet the rule of 88?
First, you just would need to receive a paycheck into a quarter to get credit for the quarter. So, for instance, if we have a person that terminates their employment in December, receives their last paycheck into January, that one paycheck into January gives them credit for that quarter. So for everyone that, as an individual, that varies. If they need that quarter to get them to the rule, you just want to get that paycheck into that next quarter.
Thanks. You went into it a little bit in your slides, but can you cover the differences between the deputies and sheriffs again, as far as meeting the different ages and years of service and things like that?
Okay, so we have our special service members and our regular class members. Special service members are our occupations generally who carry a weapon, or our correctional officers, airport firefighters, police officers, etc. And they have a different formula when we calculate their payments. First, with our sheriffs, they can actually retire at age 50 with at least 22 years of service. Everyone else in the special service, they still have to be at least age 55. And their benefits are calculated differently than the regular class members. With our regular class members, you do have to work 30 years to get that full 60% of the average of your salary. Whereas with our special service members, you only have to work 22 years to get that 60% of your salary.
Perfect. Thank you. Are there any advantages of working beyond the rule of 88? For instance, 62 years with 35 years of service.
At the point that you do meet a normal retirement, which is the rule of 88, someone 62 with 20 years of service, or someone age 65. In addition to that, if you have met 35 years, at that point you'll receive no more than 65% of the average of your highest salary. The only thing working for you at that point is in the event you would see some substantial increase in your wages. Otherwise, as far as your IPERS, you're going to see minimal to no increase.
Thank you. How is IPERS affected when you go part-time? Will it change your monthly amount? Will it increase your years but decrease your salary?
It depends on that. If you're working full-time and you do not terminate your employment, but instead you change your status from full-time to part-time, in that event you remain a covered employee. So as long as you continue to receive a paycheck into the quarter, you are still accruing years of service. Whereas if you have a member who terminates their employment, then they are reemployed as a new employee. Sometimes you can be rehired initially as non-covered, meaning you would not be paying into IPERS. And in that case, you would have to requalify for coverage. But as long as you're getting a paycheck into a quarter, you're getting credit for that quarter, still accruing your years of service, And at that point, we would still calculate your monthly payment using your highest average salary, regardless of when those years may be.
Thanks. Does IPERS count as income for Social Security? So if you pull Social Security at 62, for instance, will it be reduced by your IPERS monthly income?
No. IPERS and Social Security goes hand in hand. Their payments are not affected by ours, and our payments are not affected by theirs.
Yeah, and we got some specific questions about years worked and things like that. Those will be sent to them, and as well, I think she mentioned on her website that there are specific calculators and things such as that, tools that you can use on the IPERS website to do that as well. There was also an email address that was in the PowerPoint, as well as phone numbers that you can call IPERS directly and talk to somebody about that also. As long as we don't see any other questions come in, I just want to thank both of the presenters for being here today. They did an excellent job. I hope that everyone found this to be of benefit. If you have any suggestions for future webinars, any suggestions for future educational seminars about these topics, or expanding on these topics, please let us know. You can email me, Rachel Bennett, or Tammy Norman, as always. And yeah, we don't see any other questions come in, so we'll wait maybe one more minute, and Matt has something as well.
Yeah, I just wanted to add some from her presentation, one of the emailed questions regarding purchasing service years. Just want to stress again, as she was saying, you can use your 457 deferred comp to buy back IPERS credits, and it does not create a tax implication for you. Whereas opposed to saving your own money in a bank savings account, you can use your deferred compensation plan, and we'll cut a check right to IPERS for that payment, and it's non-taxable. So something to consider there. If you think your IPERS and Social Security will be enough for retirement, use your county's 457 plan to buy back those service years if that's something you think you might do.
Okay, here's a question that came in. If you're retired at age 55 and began taking IPERS and then became an elected official covered by IPERS, how are your benefits handled?
So for any of our members, if you're retired and you started your payments and then became an elected official, even if not an elected official, anyone who's gone back to work, we wait until you stopped working again for the second time. And at that point, we would recompute your benefits at the time of termination.
Thanks. Okay, again, thank you for being with us today, and we will go ahead and end the presentation. Again, this recording will be on the ISAC website in the future. Thanks again.